Is it wise to use my home equity for home improvements? I would say yes, it depends on the home improvements that you're doing. If you are upgrading your house or you're updating your house that is in congruence with the other houses that are in your market. For example, let's say you in your neighborhood, you're the house that doesn't have the updated kitchen or the updated bathroom, whatever. To do those kind of homes and home improvements is going to increase your value. I am Brandy Whitmire. I am with the Brandy Whitmire mortgage team. I am nationwide. I have every loan that you can think of, every product that you can think of under the planet. If I don't have it, I will find someone who does. I'm going to help you no matter what. So if you have any questions regarding financing or loans or debt consolidation or real estate, reach out to me. That being said, let me know any questions that you have in the comments, because that's the point of this. I want to know real time. So what I have tonight are some questions that I've gotten the last week or so on anything mortgage or real estate related. So this week, I've gotten a lot of questions on, not a lot. I've gotten a couple questions on like the Redfin. You're seeing a lot of Redfin ads out there for 1%, right? So people are calling me and saying, "Hey, I saw that loans are down to 1%." I'm like, "Wait, what? No. What do you mean by that?" Well, Redfin's offering 1%. So I wanted to explain a little bit about that. Like what? Roll Tide, roll, Matt. Okay, so I want to explain a little bit about the 1%. So the 1% on Redfin basically means that you're paying 1% on the buyer side of a selling transaction. So if you're selling your home, you're going to pay 1% plus admin fees, plus advertising fees, plus whatever fees they have. So it's important to look at that. Now, whenever you have a seller side, you still have to pay that 3%. That has nothing to do with the interest rate. Just like if you see a car loan or a car whatever, and they say, hey, a car, like, hey, I saw I can get 2% on my car for an automobile loan. That's not the same as a mortgage. So it's important that you understand that what you're seeing on Redfin, even though it does say 1%, it's not actually 1%. So you definitely want, if you want to know more, definitely ask me, because there are some things I can't say on video. If you want to know more about that, definitely contact me, because I will explain to you what that means. So that's my biggest thing this week, is the 1% that's being advertised out there. That has nothing to do with mortgage. Mortgage, if you can go on Zillow, Bankrate, LendingTree, blah, 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 those rates that you see, they have stipulations. So you want to know, you want to see exactly what your specific parameters are and what that means. Okay, I have a question. I have been thinking about consolidating debts with home equity, or would it be better to save my equity? Okay, so good question, Nicole. If you have a home and you have some equity in it, so whether you've paid it down or whether the value has gone up recently, you want to look at what's the interest rate. So to your question, if you have credit cards that are 23%, if you've got student loans or whatever the case may be that might be over 10%, and being able to consolidate that frees up cash flow, then it might make sense. Not always, but sometimes it does. So let's say you have all these other debts that are above 10%, and you're worried about adding that onto your home debt. If I can get you into a loan for 4.5% or 5% or 4% or 3%, whatever the case may be, but I'm saving you your monthly cash flow, and now your $2,500 goes to $2,000 a month or $1,500 a month, would it be better for you to go to a 15-year or a 20-year on your house so that you can pay off those debts and only have one payment? Absolutely. You're going to have to be diligent. You're going to have to be disciplined in order to pay those debts down, in order to pay like what you would normally be paying back onto your house. A good way to do that is to go to a 20-year or a 15-year so that you're forced to do it, but you don't have to. You can still go to 30 years. So it depends on where you are in your life and what your actual goals are. For me, it always makes sense, because if I'm paying something that is a higher interest rate, obviously it makes sense to pay a lower interest rate. But I also know that I'm going to go to a 20-year or 15-year on my mortgage, and I'm going to be able to pay those debts down faster and pay my mortgage down faster, because I have more positive cash flow. I'm not paying $2,000 a month towards my debts. I'm paying $1,500, and I'm still paying it down faster. Curry. Oh my gosh, it's been so long since I've seen you, Curry. 2008, I think, is the last time I saw you. Wow. When will we see another rate hike? Okay. If I knew that, I would be a billionaire. However, when will we see another rate hike? I think it's inevitable. It's always going to be inevitable to see a rate hike and a rate decrease. No matter what. I've been doing this as of April 22nd. I've been doing this for 19 years. There's always going to be a rate hike and a rate decrease. Right now, rates are lower than what they were. People seem to think that rates are still high right now because they're in the fours. Whenever we had a couple of years ago, they were in the threes. Although today I quoted a 15-year at 3.375. I quoted a 30-year at 3.875, but that depended on their parameters. They had 20% equity, they had this, that, they didn't want anything to be paid. Some people are being quoted at 5%. It just depends on you and your specific parameters. So right now I'm quoting, literally as of today, 3.375 to 5%. So to your question, when will we see it? Maybe tomorrow. I mean, it just depends. The good thing about knowing about a rate hike is that it's going to go lower. Rates are going to go, they're going to fluctuate high to low. So it doesn't mean to not buy something or not to take action, because there's always going to be opportunity in the future to go lower or go to a lower term, which means you're going from a 30-year to a 20-year to a 15-year or something like that. And you're going to be able to get a lower rate or, bigger incentives. So, good question. Okay, another question. Is it wise to use my home equity for home improvements? I would say yes. It depends on the home improvements that you're doing. If you are upgrading your house or you're updating your house that is in congruence with the other houses that are in your market. For example, let's say in your neighborhood, you're the house that doesn't have the updated kitchen or the updated bathroom, whatever. To do those kind of home improvements is going to increase your value. It depends on how much you owe. It depends on where you are. It depends on what the value is now. It's always, always, always a good idea to keep your home updated. That way you're always selling at the highest and best value in your market. And plus, doing improvements to your house also decreases the likelihood of finding other problems. For example, should I replace my roof now? Well, I would say yes, because if you don't replace that roof, you could have water leaks, you could have mold, you could have termites, you could have things like that. So it's always important to keep your house upgraded. As far as cosmetics or aesthetically, that's up to you. If you're going above and beyond, just know that you might not get that. For example, I had someone that had a pool that they added in, and they spent $50,000 on it. You're not going to get $50,000 equity back because you spent $50,000 on a pool. You might get 10, might get 15, but you're not going to get 50. So it depends on how long you're going to stay in that house and what your goals are. If you have those types of questions, it really is a case-by-case basis. Let me look at it. I have a national resource on comps and what your house is worth and things like that. So if you have questions on what your house is worth now, I have that data. If you want comps in your area, I have that data. Just reach out to me and say, hey, here's my address. What can you see? And I'll send you a free home evaluation anytime, no problem. I'll send to you, no cost to you, no obligation. I'll just send it to you. That way you at least know about your neighborhood, what's happening in your neighborhood and all that. I've got that data for you. So just reach out to me. all these questions I'm going to say are going to end up with me saying, reach out to me and ask. There's never an obligation to work with me or do anything. Obviously, I want you to. I want your business. I'm going to do whatever it takes. I want to take care of you. But at the end of the day, I just want to educate you and give you that information to make sure that you know what you're doing and make sure that you have the right information to do whatever you need to do in your life. Okay. Let me see if there's any other questions. I like that explanation. Good. And by the way, if I'm ever not explaining something to your liking, let me know. I'm open to that. I want to be able to give you that type of information. Okay, I don't see any other questions right now in the feed, so I'm going to go back. So here's another question I have on what's the difference between an interest rate and APR? This actually did come up this week. So I have a friend who I'm refinancing him right now, and he said, hey, I have 3.5% right now, and you're putting me at a higher rate. Why is that? And it was a good question. I was like, okay, I get that. First of all, he had a 3.25% rate. He was paying $250 a month in mortgage insurance. He has well over 20% equity, which means there's no need for mortgage insurance, number one. But if you add on mortgage insurance to an interest rate, so he had 3.5% interest rate, but he was paying $250 in mortgage insurance. That means his APR, the cost to do the loan, was already close to 5%. And he was getting cash out to pay off debts and things like that. So does it make sense? What the difference between APR and interest rate? It's definitely a good question to ask because the cost of the loan, which includes mortgage insurance and closing costs, is a big deal when it comes to knowing the actual price of the loan. So an FHA loan, for example, you're going to get a low interest rate, but your APR is going to be high always because you have mortgage insurance. So again, ask me. I'll let you know where we are in current market, if it's going to make sense for you. The good thing about this for you as a consumer is that as a loan officer, I cannot do a loan for you that is not beneficial for you. It's illegal. It would be illegal for me to do that. So when you are a consumer getting a loan, no matter what, there's no possible way for you to do a loan and it not be beneficial for you on a refinance because there's something called net tangible benefit, and we cannot do that. Last question. What if I'm looking to buy a new home? What does it cost to work with a realtor? Okay. As a consumer, whether you own a home or not, whenever you are going to buy a home, it is absolutely no cost to the buyer. The seller or the builder always incurs those costs. So whenever you are a buyer, it costs you no money to buy a home as far as closing costs on the actual sale of the home. You're going to have closing costs on maybe your loan, but you can get that taken care of through seller concessions, through lender credit, through through down payment assistance, through things like that. So as a buyer, you never have closing costs as far as buying the home on the actual sale of the house. It's always going to have to do with your loan. So if you don't want to have closing costs, let me know. I can show you exactly how to not have any closing costs if it's available to you through lender credit, seller concessions, or down payment assistance. So yes, Nicole, even in an investment property, no matter what, there's always possibility to do that. So that was my last question. I love these questions. I have more questions here, but I'm going to save that for next time. If you have any more questions for me, leave in the comments. I'll comment on them directly to you. I'll DM you. You can always reach out to me on any platform. Again, I'm Brandy Whitmire. You can reach out to me at 972-913-6959, bwhitmire@financemyhome.com, and always just Google Brandy Whitmire. You're going to find me anywhere. You can reach out to me anywhere. And again, love educating, love helping you. Reach out. I'll talk to you next time.